The bank says you qualify for a $500,000 mortgage. But does that really mean you should borrow that much? One wrong decision could cost you hundreds of thousands of dollars over the years. For some people, continuing to rent is actually the smarter choice, at least for now. For others, buying a home makes sense, but only if the mortgage fits their financial situation. If you enjoy personal finance content backed by real data and practical examples, be sure to subscribe so you don't miss future videos. Let's take a look at 3 American families, each with different incomes, credit scores, and financial situations. Our first family is Ryan and Emily Carter. Our second family is Michael and Jessica Miller. And our final family is David and Sarah Thompson. Together, we'll determine how much mortgage each family can realistically afford, what type of home best fits their budget, and ultimately, whether they should continue renting or if it's finally the right time to buy a home. Let's start with Ryan and Emily Carter. Their household earns about $140,000 a year, and they're currently renting an apartment for approximately $2,200 per month. They've saved a 10% down payment, have a 680 credit score, and have been pre-approved for a $470,000 mortgage. At first glance, it may seem like they're ready to buy a home. But let's take a closer look at their overall financial picture. According to the 28% rule, their monthly housing payment should ideally stay around $3,250. However, every month they already spend about $1,500 on expenses for their 2 children, $1,100 on groceries, nearly $900 on their car payment and auto insurance, around $500 on utilities and internet, and another $900 on health insurance. That brings their regular monthly living expenses to roughly $7,100, not including unexpected costs like car repairs, children's clothing, or weekend family activities. If Ryan and Emily borrowed close to the full amount the bank approved, their monthly payment, including the mortgage, property taxes, homeowners insurance, and PMI, would be around $3,900 to $4,100.
That's well above the recommended limit under the 28% rule. On top of that, because they're putting down only 10% and have a 680 credit score, they'll also have to pay private mortgage insurance, PMI, each month, making homeownership even more expensive. For Ryan and Emily, a mortgage of around $350,000 to $380,000 would be a much more comfortable fit. At that price range, they could consider buying a condo or townhouse where the monthly payments are easier to manage, even if it means accepting less living space and paying an HOA fee. However, if they don't need to buy a home right away, the smarter choice may be to continue renting for another 2 to 3 years. By consistently saving about $1,500 per month, they could build an additional $54,000 over 3 years. That larger down payment could help eliminate PMI, improve their financing options, and potentially qualify them for a better mortgage rate. Their situation is a perfect example of an important lesson. Just because the bank approves you for a mortgage doesn't mean it's the right mortgage for your family's budget. Our next family is Michael and Jessica Miller. They have 1 young child and are currently living with Michael's parents. For many people, that might not seem like the ideal living arrangement. But for Michael and Jessica, it's a smart financial strategy. Instead of paying rent every month, they're using this time to save aggressively for their first home. Their household earns about $190,000 a year. Both have stable careers, a 760 credit score, and they've already saved a 20% down payment. Based on their financial profile, the bank has pre-approved them for a mortgage of approximately $650,000. According to the 28% rule, their monthly housing payment should ideally stay around $4,430. Right now, their monthly living expenses are about $5,800. Since they aren't paying rent, they're able to save an additional $3,500 to $4,000 every month, allowing their emergency fund and home savings to grow quickly. However, if they borrowed close to the full $650,000 the bank approved, their monthly payment
including the mortgage, property taxes, and homeowners insurance, would increase significantly, reducing their ability to save and putting much more pressure on their household budget for years to come. Instead of borrowing the maximum amount, a mortgage of around $380 to $430 would be a much better fit. With that budget, they could comfortably purchase a newer townhouse or a single-family home priced between $400 and $420. That provides enough space for a family of 3 while leaving room to grow in the future. And because they're putting 20% down, they won't have to pay private mortgage insurance, PMI, which helps keep their monthly housing costs lower. More importantly, after buying their home, Michael and Jessica would still have enough room in their budget to cover childcare expenses, maintain a healthy emergency fund, continue investing for retirement, enjoy family vacations, and keep up with the rising cost of living. Their story shows that the best time to buy a home isn't when the bank approves you for the largest mortgage. It's when your monthly payment still allows your family to live comfortably while continuing to build long-term financial security. Our final family is David and Sarah Thompson. They have 2 children and are currently renting a single-family home in a neighborhood with highly rated schools. Their household earns about $240,000 a year. Both have stable careers, a 790 credit score, and they've saved a 20% down payment. Based on their financial profile, the bank has pre-approved them for a mortgage of approximately $820,000. On paper, David and Sarah clearly qualify to buy a very expensive home. But that doesn't necessarily mean they should. According to the 28% rule, their monthly housing payment should ideally stay around $5,600. In addition to their current rent, they already spend a significant amount each month raising 2 children, investing for the future, and saving for retirement. Their total monthly living expenses are roughly $9,500 to $10,000. If they borrowed close to the full $820,000 approved by the bank, their monthly mortgage, property taxes, and homeowners insurance would consume a large portion of their budget, forcing them to cut back on or even delay other important financial goals. Instead of borrowing the maximum amount, a mortgage of around $650,000 to $700,000 would be a much more balanced choice. With that budget, they could comfortably purchase a single-family home priced between $800,000 and $900,000 in a neighborhood with an excellent school district. It would provide plenty of space for their family and a stable place to live for many years. Of course, homes in this price range typically come with higher property taxes and maintenance costs, but those expenses would still fit comfortably within their budget. More importantly, after buying the home, David and Sarah would still have enough cash flow to continue contributing to their 401k, Roth IRA, and their children's 529 college savings plan. They could also maintain a healthy emergency fund, enjoy family vacations, and handle unexpected expenses like car repairs or home maintenance without putting their finances under unnecessary stress. Their story illustrates an important lesson. Even if you have a high income and qualify for a large mortgage, the smartest decision isn't to borrow the maximum amount. It's to choose a mortgage that lets you buy the home you want while preserving the financial flexibility and peace of mind your family will need for years to come. Looking at these 3 families, one thing becomes clear. There's no one-size-fits-all answer. For Ryan and Emily, continuing to rent is the smarter choice. They're raising 2 young children, their monthly living expenses are already high, and they need more time to build a larger down payment. By eliminating PMI and increasing their equity, they'll be in a much stronger financial position when they're ready to buy. Michael and Jessica, on the other hand, are in a very different situation. Living with Michael's parents has allowed them to save a substantial amount of money each month. Given their current financial position, now is a great time to buy their first home, create a place of their own, and prepare for their child's future instead of delaying the purchase any longer. As for David and Sarah, they could certainly afford a more expensive home the bank is willing to lend. Leaving room in their budget allows them to keep investing, maintain an emergency fund, save for their children's education, and handle unexpected expenses without putting unnecessary strain on their finances. In the end, the right decision isn't about borrowing the most money possible. It's about choosing a mortgage that allows your family to own the right home while maintaining long-term financial stability, flexibility, and peace of mind. Don't ask yourself, how much will the bank lend me? Instead, ask, how much mortgage can my family truly afford each month? The amount you should borrow isn't determined by your income alone. It also depends on your credit score, your down payment, the 28-36 rule, and your family's overall living expenses. The right mortgage isn't the biggest loan the bank is willing to approve. It's the one that still allows you to raise your children, invest for the future, build an emergency fund, enjoy family vacations, and handle unexpected expenses without stressing over your monthly mortgage payment. In the end, a home should provide stability, security, and peace of mind, not become a financial burden that follows your family for years to come.